stocks reaching levels not seen since before the Great Recession. The Dow and the S&P continue to hit multi-year highs, but could we be in for a correction? Jim Frischling, NewOak Capital President, and Drew Canale Trust Chairman, both join me now. And Drew, you say a correction is overdue. Jim, I know you're more bullish, but Drew, I want to start with you. Why are you worried about a pullback considering these numbers we're hitting over and over every session?
Well, I mean, you just typically, when you're sort of in a secular bear market, you'll see a correction after this period of time. It's just kind of the reversion to the mean kind of look at it. But if we're emerging from this secular bear market and moving into a secular bull, then you shouldn't be concerned. And so really, for long-term investors, you should be looking through this. If you've got a lot of cash and you're looking to commit to the market, you might just take a pause here and look at that for a minute or two, especially when you have
votes coming up in the House. But I think we need to focus on the short term because there's a lot of unanswered questions for our viewers and, of course, their investments. And Jim, I know that you are looking short term, but you're saying that this rally absolutely is going to continue for several strong reasons.
No, I think that's right. I mean, we certainly believe that much of this rally and much of the reason for the multi-year highs we've achieved has been on back of the Fed and central banks globally making a commitment to low rates and providing stimulus. And while it's hurt the dollar relative to other currencies, it certainly has resulted in essentially the doubling of the S&P and the Dow. We also have equity holdings still at a near historic low. And so what was the Great Recession is now going to become the Great Rotation. And we're going to see insurance companies, pension funds, and we're looking at Lipper numbers that suggest funds are now flowing back into equities, where over the last 5 years, far more money was pulled out of the equity markets and into bonds. We're now seeing market money flowing back into equities. We've got corporate buybacks, which are hitting all-time highs, which are good for earnings. And we also have, PE ratios still suggesting they're not at their historical levels, in which case we think the market is not even overvalued on that basis.
But at the same time, Drew, I mean, you say that one of the things, and this is where Jim points out that the Fed has powered the markets higher, you say, hey, that's going to run out. That could run out this year at some point, depending on what the Fed decides to do, and that could be another short-term negative, in your opinion.
Well, I mean, no, the Fed unwind is another matter, but let me repeat something. What Jim just said is correct, okay? I mean, stocks are under-owned. There is a rotation that's imminent, and what I was talking about with the Fed is in terms of allocating to fixed income, you're looking at a 30-year trend that's coming to an end. And so the probability of repeating success in fixed income going forward, given that the Fed is going to have to unwind at some point, is very low. So it is at the point in your allocation you need to be thinking about more long equity. You need to be thinking globally and emerging markets. So it's what I was talking about at the top of the segment is, technically speaking, you should be due for a correction here. But if fundamentals continue to be strong, you may blow through that technical overbought position.
But Drew, another thing is the debt ceiling debate, and that is another short-term event that the markets have to deal with.
More than likely, you're going to be living with a debt ceiling debate this quarter, next quarter, the quarter following that, and until we come up with some sort of plan to exit this nonsense, you're going to see this debt ceiling debate go on for some time. So probably presently you should be looking through it, and if you look at the market action, they're looking through it.
Okay, Jim, last word. Do you agree or disagree with that?
Yeah, I disagree with that. Not that it's not going to be a real debate, but the market is no longer going to fall for the rhetoric of Washington and the digging of heels, resulting in a pullback of what we've seen in the past of anywhere from 10 to 15%. We didn't see it in the fiscal cliff debate. The market was not falling for it, and they're not going to fall for it this time.
Jim Frischling, Drew Canale, thanks to both of you. Appreciate it. Love to get the different views. Guys, thank you.